Hello traders, I'm Francesco, this is FreeFX, welcome to my channel, and today we're going to talk about lots of things because it's an exciting week. It's a week before the Fed rate decision, so if you follow my videos that's one of the main focal points, and it is a focal point for many people, institutional money, private retail traders, investors, just the economy, etc. So it's a talking point. Let's begin then with a couple of things. First of all, 2 updates a week, so Mondays and Fridays, and today obviously it's the start of the week, so I'm just going to introduce the week in trading. Also, this t-shirt is quite ironic, and my sister gave me this. It says I'd rather be trading, but it's got a sort of bullish up arrow, which is ironic because now I'm mostly shorting the market, so and we're in a bear market. So anyway, apart from that, it's a great t-shirt, so let's wear it. Now this chart here is the weekly chart of the S&P. Now I trade the SPX rather than the SPY or the SPY, so not SPY ETF, but the SPX based on the options, and it's through Wanda, and it's exactly the same pretty much. So obviously it's not like futures or where it sort of gaps down or gaps up at the open. You've got the US Open, you have to wait, there's a break in the data. It's continuous in terms of the candlesticks, and price is continuous. There's only 1 hour break in trading, and basically new candles between 11 UK time and 10 o'clock, so an hour between 10 and 11. Apart from that is continuous, which is why I like it really, because I've come from Forex trading, which is continuous through the week, and I prefer this style of trading. Also is measured in pips, etc. So it's very much like a Forex approach to the S&P index. Now the weekly chart, so this is the SPX, but you'll probably see the same in the SPY. The weekly chart, I put well, just a drawing there really to highlight what's the obvious. Now I had a line here before which was running at the top, but actually it's now forming, instead of just being a line, a resistance line, it's forming a wedge. So we can call it terminal wedge or whatever. So price is really just squeezing and squeezing and squeezing. So the volatility is lower and lower. So if I took this off and put in something like an ATR, that will sort of seal the deal. You can see what I'm trying to tell you, that we have a declining ATR. That's on the weekly. It's even more severe on the daily. So if I went to, and that's the 14, I do everything on the 21. So if I just change 21, that's the 21. Okay, so very similar. And if I go to, so this terminal wedge or triangle, as you want to call it, is a it's kind of like a, not even an ascending triangle, but yeah, let's call it an ascending triangle, because there's a top and the bottom is rising to meet the top, and the top is flat, so it's an ascending triangle at the end of a bear trend. So what we could do is go to I think it's chart patterns. I think it's called the pattern site. Here we go. Now this is an amazing website. So when I was studying for the CMT Chartered Market Technician level 1, I came across this. It's absolutely wonderful, and it's just incredible. And so Bulkowski published all these patterns and the results, and statistically kind of measured them, how effective they are, etc., etc. So I just wanted to show you this because it's quite incredible. And if we actually search it by pattern rank, so which ones are the best, etc., let's look at that, and we see the top ones here. We have the alphabetical, and we've got triangles, ascending triangles. So here's the stats for ascending triangles. Okay, if you can see that, make it a bit bigger maybe. We've got performance rank up breakout. So upward breakout is ranked 16 out of how many? That's funny. I should know this, but anyway, it's number 16 out of 39 is the worst. 16 out of 39 is ranked the upward breakout of a rising ascending triangle. Then we've got the performance for a downward breakout is 30 out of 39, so really not so good. And then failure rank, upward breakout 27 out of 39, so 35 the downward breakout failure, so it breaks out to the downside and then that fails and goes back up. It's 35, so nearly the worst. So what it's saying is actually an upward breakout and its rate of failure are better than the downward breakout, which would suggest that there's kind of more chance of a success of this breaking out to the upside. Okay. Now what's happening is that the Fed rate decision happens next week. Happens. And that's on the 27th. So we probably need to wait until then. This week leaves us a little bit of space here for next week to squeeze price action even more. And if we go to the daily, obviously we can see how severe that was. And that's the ATR there, completely kind of, I'd say collapsing, but you know, certainly because if you look at previous levels, we are back to levels that we saw in April. So it's pretty low, you know, considering where we've been. We're at sort of 86, and we've been up here at 108. Okay, that's pips, by the way, per day. So we're down here to the 80s, and so you can see this price kind of getting smaller and smaller. But anyway, going back to what we were saying, if we look at the triangles, you know, that's kind of the success or failure rate. But you know, it doesn't have to be this every single time. But statistically, the upward seems to have more of a chance of succeeding. Although it's not impossible that the downward would fail. Okay, so we're in a bear trend, therefore. Now, performance rank, and I think we've obviously tapped this one, but let's kind of go through this. Bull market, here we go, this kind of differentiation between bull market chart patterns and bear market. So let's kind of go to the bear market chart patterns. If I can find that. There should be one for bear markets, I think. Or maybe not. Downward breakouts. Okay, maybe there isn't one. I thought there was one for bear markets, but I don't seem to find one. Let me just see. So if I did downward breakouts, would that take me to the? Oh, it's still the bull market. Okay. So in a bull market, a triangle, for example, in a bull market, a descending triangle. So the reverse of what we've got, which is a bear market with an ascending triangle, would have a performance rank of 15 out of 39 and a failure rank of 18. So we don't know what the reverse would be like, but you know, let's kind of assume that. Let's see what this gives us. Oh, that's the actual book, right? Okay. Anyway, you can have a look at this, and I thought I might just kind of introduce that because it's a really you know, I did a video actually on chart patterns, which has proven to be quite popular. And I think I talked about this website in that one as well. So it's a really good website if you're into chart patterns and want to trade them. I don't trade the patterns, but certainly it's good to know when you visually see one what it's likely to happen next. So I'll just come out of that for a second. The other thing we need to discuss is earnings season. So tomorrow we've got Netflix. We've had Goldman Sachs today. Not such an amazing kind of performance. Tomorrow we've got Netflix, which has been kind of net negative in terms of earnings per share year to date. So expectation, not sure what they are, but you know, unlikely to be such an amazing surprise. But again, there could be a surprise. So the following day, the Wednesday, is Tesla. Then that's kind of, these are the kind of the most anticipated earnings. Not all of them. You can get the full list from the Nasdaq or the Yahoo finance list, but I just wanted to use this because it's the ones that I'm really interested in, which is the FANGs, Facebook, Apple, Amazon, Netflix, Google. Obviously Google is now Alphabet, and Facebook is kind of Meta, but essentially that's them. So next week actually is where we have the most concentrated group of these. So Netflix is tomorrow, which is very important. Not sure of the time, but anyway, Alphabet and Facebook, and then we've got Apple and Amazon. So these 3 days are packed full of things. Okay, so I would sort of keep an eye out, and then we've got the obviously the Fed rate decision on Wednesday evening for me. That'll be afternoon for you, and that's really important. So that's something to keep in mind. As well as that, we've got the economic calendar also packed with things. We've got tomorrow is the CPI for the Eurozone. We've got housing starts for the US and building permits. Very important, the whole discussion about cooling down the housing market, what the Fed cannot or can do, and what the fiscal policies might be to help people getting on a housing ladder without exacerbating a housing bubble, which has been pricked really, so with cooling down of demand. But important as well that there are homes being built, so building permits obviously reflects the health of the economy, because people need to live in houses, and there aren't sufficient houses, or that seems to be the pattern, and so building houses is important, as long as they're affordable. Obviously that's a different consideration. Wednesday, home sales again for the US. Thursday, ECB rate decision. No press conference, but rate decision, and then jobless claims, etc. But we've had the NFP data already, so unlikely to be a big surprise. Then we've got more services PMI, manufacturing PMI for Eurozone and US. So that's the calendar there. So, and there's no shortage of ammunition. Now, I'm going to go back to that tab that you just seen, which is my stats. I'm just going to close this and go back to the CCI. So let me go back to CCI. I think I just put a low chart. Okay, whilst it's loading, I'm just going to say very quickly that the week that we have in front of us is an amazing week for lots of reasons. And let me go to the weekly. So we have this triangle likely to break out upward or downward. Seems to be wanting to go down. We've had 2 weeks of bearish action, but obviously quite limited in range. The CCI is showing kind of oversold in a way. It was bounced off twice, and we're looking for a bounce of some kind, which we've had, and it's moving up, but then price isn't really supporting that at the moment, so it could be a fake kind of bounce. So if we go to the daily, you'll see a bit more detail. We've had this sort of chop, going above the 0 level and back below and above again, but it's a lower rate, so we don't really have much of an inclination to rise. And as I mentioned before, we have these descending tops 1, 2, and now 3, suggesting that price isn't really making progress to the upside. Yeah, so increasingly we're sticking to the bear trend. That's my interpretation of it. Bollinger Bands are squeezing. We've got this sort of terminal wedge or triangle, more visible in a weekly, and so we're expecting some kind of expansion again at some point, because we've had quite a bit of narrowing range there, which, as you know, if you know your Bollinger Bands, that's a sign that something is going to give. Go to the 4 hour, which is my favorite time frame. We have these tops at 200, and we're coming lower and lower, still in the 200 region, but less inclined to rise higher. And I think we're descending further into the negative 200, so I expect that we might see more bearish action. Now today I had a really good trade. I basically traded from almost the top here to down to the middle line, and or I should say, sorry, the middle line is this, and the weighted moving average is this. So I actually traded all the way to the weighted moving average and then sort of closed. I just missed a little bit of extra move here. You can see the wick there I didn't want to risk it, so it actually went down all the way almost to the SMA, the 20 SMA, 20 period SMA, but I didn't want to risk it, so I just closed a little bit earlier. So, and sorry, 21 period SMA. So, very good trade today. Very happy technically with this setup where it sort of pushes onto the outer Bollinger Bands, starts basically reversing the CCI up to the 200 pretty much. It was 182 I believe, and then started rolling off and came nicely down. So that was the sweet spot for me. CCI Bollinger Bands working really well together, getting enough volatility on the trading range for the day. But you know, when you have that, it's a really sweet spot, and you know, it happens time and time again. And that's what I love about this combination of indicators: a commodity channel index, Bollinger Bands, and also the weighted moving average, which is usually a little bit higher than the standard moving average, simple moving average, sorry, and that comes standard with the Bollinger Band setup, and that sometimes catches the end of a move rather than the actual. So for the target, I had 2 times ATR, which came to about 60 pips, and the stop was at 30 or 31 pips to the upside. So kind of roughly where this Bollinger Band would be. That worked really well. I actually closed it manually before it got to target, but I wasn't far off it, so excellent stuff, excellent stuff. Now, so I'm just going to go to my stats, because I think this might be really interesting. So I've done a custom stats analysis from the beginning of February, and the reason for that is that, as I explained before, January was pretty bad, and also the end of last year was pretty bad. I started trading the S&P in September, and really started getting into it in October, having traded Forex for a number of years. And I explained this before, but just as a reminder. So anyway, so my best stats were October, I believe, and then after that, November I think was okay, or December wasn't so good, January wasn't so good. I was kind of getting into the market when it was starting to turn from the bull trend that came after the COVID, the first breakout of the coronavirus 2020. I was coming to that late stage of that bull trend, and it was turning, so there was a lot of chop. It's starting to kind of break lower, and then January started breaking lower properly. I was going long, thinking it was like a temporary breakout, staying in positions too long, getting bigger losses. So I got a bit eaten alive. But after that, in February, I started being more consistent, following the current trend, and being a bit more patient, just letting price do its thing and entering less trades, being a bit more consistent. So all in all, it makes sense to not just to make it look good, but it makes sense to actually look at from the moment that I actually started, you know, doing a proper trading strategy. I was just testing the waters before. It wasn't really so I tend sometimes look at the whole, you know, strategy from the start, from last year. Sometimes I look at February. So just to show you effectively what I managed to do from the start of February. Okay, the gain looks quite impressive. I know that's kind of easy one to kind of market myself, but I'm not marking myself, but I'm just saying that that is pretty good. In terms of numbers, you know, we're looking at very small numbers here. So the lowest point there, kind of starting in February, had £47. Just to give you a sense, you know, not like talking millions here. And closest today, it was 218. So, you know, take the percentage gain there, the absolute gain, with a pinch of salt, because I haven't just, you know, won the lottery here. But what I'm interested in doing is building this up, back up to what it was. And, you know, I'm trying to be consistent. Now, I had during the May Fed rate decision, I had a bit of bit of chopping, and I tried too hard. So I learnt my lesson not to try too hard during rate decisions. So for the June one, I stayed out of the way, and for the July one, which helped a lot, and for the July one, I'm basically also going to stay out of the way until the Fed rate decision is done and dusted, and see what happens like the next day, basically. That's kind of the policy now. So avoid that event risk and just stay out of it. So because that cost me, you know, a little bit. There was a dip there from £106 to 65, which is, you know, pretty severe. So again, just staying consistent and trying to build things up. Okay, so that's kind of the stats generally. What I'd like to show you as well is this is, you know, very interesting as it is, but what I'd like to show you is if I look at this, which is kind of more the breakdown of my trading from February. So February, March, April, May, June, July, kind of 6 months or 5.5 months of trading. So 143 trades, which, you know, if you divide it by roughly 6 months, it turns out to be, what's that, 20, well, it's kind of like 20 trades plus a few, so 24 trades, 24 trades, yeah, roughly. 24 trades per month, which is not many if you think about it. And what's interesting about this as well is these stats on the right. So MyFxBook uses its own analysis tools. If you go to something like FundSeeder, that will give you a different set of tools. Your broker might give you different tools like Oanda, FXCM, I think of other brokers as well, but those are the ones I tried. So profit factor 1.65, and that means that the higher the value, the better. Is how many times the gross profit exceeds the gross loss. And if you look at my average win is 30.76 pips, and the average loss is -27. The average win trumps the loss, not by a huge amount, but it compounds. And then the best trade was in value £34, the worst trade in value was -12. So when you look at the actual value of the trades, then not just the number of pips, then you can see there's even more of a divide. So my losses in terms of value are smaller. Sharp ratio is kind of low, is 0.02. Obviously we want that to be higher, and that's the risk versus returns, and the probability of a profit followed by a profit and a loss followed by a loss. The Z score is 37.59%, and the AHPR, the arithmetic average holding period, is 1.34%. So the system makes on average 1.34% return on each trade, and that's sort of compared to also the profit factor. Okay, so these two I'm watching. Standard deviation, that's the statistical measure of volatility, as we know, how much variation or dispersion there is from the mean expectancy. Okay. And it's given it in pounds as opposed to anything else, which may or may not be clear. Maybe a percentage might be easier to kind of understand. So we covered all the things, I think. And the other thing I was going to cover is profitability. So 184 out of 143 trades, so 59% won and lost 41% of the trades. So almost a 60-40 split, which again is enough of an edge to give the system tipped to profitability. So we can always improve the edge without taking too many risks. So it's finding that balance of that. There's a lot of work to be done here. I mean, I've listened to so many traders on Chat with Traders with Aaron Fifield. You know, check that channel if you haven't listened to it yet. And it really is quite important that you sort of work on these as well. Sorry, I disappeared there for a while, so I found myself again. So it's really important to work on these things. And again, going back to these, so Chat with Traders, check out the one of these videos, and it's also important to look at things like Better System Traders. Better System Trader, again, check the link there. And you know, there are so many. Now, just to give you some news, I've joined the Society of Technical Analysts, which sounds fancy, but actually it's a serious society, one of the oldest in the UK. And it basically, because I did my CMT level 1 in December 2020, I did my exam, I passed it, and so I wanted to kind of carry on, but the level 2 and level 3 are massive, and the level 2 book is like over 800 pages to learn, versus 600 and something for volume 1. Volume 3 is even bigger. They're big exams, and I mean, the first one really had me. Is during lockdown. It's just a lot to do, and but you know, I don't know if I'll be able to do 2 and 3. There is a diploma with Society of Technical Analysts, and it's in 2 levels rather than 3, and again, it covers a lot of ground I've already covered in a way, so I think that might be the road for me to end up with a qualification in technical analysis. So that might be more user-friendly for me, because, you know, I don't do this for a living, so it's kind of time out of my own sort of working time, family time, so it's very important to kind of do that. So that's the Society of Technical Analysts. I'll put the link there of one of the videos, and yeah, just great place, and they've got forums and meetings and resources, so fantastic. I also, we talked a lot about the Fed, so there's a lot of talk about, you know, is the Fed causing the problem in the first place? Because printing money is not a solution to the economy. Printing money basically exacerbates the kind of aspects of inflation that we don't like. So by putting more money into the system, the end result is essentially you are creating the very inflation that you're trying to fight, because you're trying to stimulate the economy. And then you know, when things get bad with inflation getting out of hand, as we've seen, you have to tighten, but then you can kind of cause the side effects of basically making things too expensive, because the rates will kind of propagate through the system. So, you know, 50 basis points, 0.5% from the Fed might end up being quite a larger rate increase on mortgages, for example. So, and I'm not an economist, but, you know, I've listened to a few things about this, and one of the sites that I've listened to for a few years now is really an alternative way of thinking about economics, is and about the Fed's role as an independent body, is the Mises Institute. So check the link again. So this is one of the websites that one of the links that I've posted about before on Twitter, and it's Mark Thornton. So I've also joined, and I got my membership today. I joined the Mises Institute as well, because they do fantastic work. So I'm just giving a shout out to all these different channels and societies and institutions, because I think they are fantastic. But going back to my trading, so listening to all these things obviously makes you aware of what professional traders and people who have a lot more experience than me have been doing for years. So I know that the road ahead is getting profitability in a better place. But going back to the summary, obviously that's the graph there. Okay, so you can see February was a sort of bounty, and then June was also quite good, and the muted months so far have been March and July. I can go into reasons and sort of look at the charts, etc., but I won't. I've looked at that, so but just so you know, I've been net positive so far, and July isn't done yet, so I don't know what will happen, but you know, I'm not taking any excessive risks. There's obviously been more opportunities in some of the months so far, and July is a quiet month. March, I don't know particularly why I didn't manage to do many trades. I cannot remember exactly, but I think maybe just the S&P wasn't performing particularly. You can go back and check what was happening in March, and if we did monthly, we can see what happened in March. If I just make that fit to the screen, and we can see March right here. That was March. So in the bearish trend, January, February, March. So clearly March, difficult one, because we had this long tail, this long wick, and started going lower, and then sort of it reversed. So I think for some of the months I felt uneasy about going long, because it felt like it was a deception by the S&P trying to get me to trade long, and then probably stop me out a few times. So probably I traded quite conservatively and tried not to get into a sort of bull trap or something. So that's probably what happened there. Always good to do this comparison to see why decisions were made in one way or the other. The other thing is the breakdown of the trades. So very interesting here that the 1 o'clock period and the 3 o'clock periods are more profitable, have been more profitable in the last sort of 5.5 months. So 75% of trades at the 1 o'clock to 2 o'clock, and 71% at the 3 o'clock to 4 o'clock. So very similar, these two. And when you look at 2 o'clock, 50%. Okay. And obviously more trades here and here than here. The thing about that is that because I'm in the European hours set up, I'm starting trading, as you can see, 8 o'clock, 6 till 8, essentially. And then the US market opens at 2:30 my time, and that means that there's a lot more volume around this area before and after. And of these, okay, when the US market actually opens at 2:30, so that hour between 2 and 3, not so good. The one before and the one after, once the market settled, or as it's getting ready towards that open, very good. So that might teach me something about trading around the 2 o'clock. Now, the interesting about that is that the 4-hour setup is at 10 o'clock, and then 2 o'clock are the candles. So the 2 o'clock candle is starting out, so you don't know what shape it's going to take, because they will have to take in the US Open half an hour later. So that's also a difficult candle to trade if you enter in a trade around that time. So best to trade the candle before, so the 10 till 2, or the 2 o'clock only after the US Open has actually come in, and then you can decide whether to enter a trade or not. And in terms of the daily, these two, the Tuesday and the Wednesday and Thursday, are good, but the Wednesday wins with 74% of winning trades. Okay, so the middle of the week is the best. Friday, okay, 56%. Monday bad. Monday bad, 44%. So clearly the lesson there is, which I'm now starting to intuitively kind of practice, to avoid trades on the Monday. So 11 trades, 11 winning trades at 25. So how many trades did I take on the Mondays? 25. On the Thursdays, 36. On the Wednesday, 27. So Monday and Friday are the lowest number of trades I've taken, but more and more that will come down because I'm taking less trades those days anyway. So, and eventually the duration is also very important. So the longest, the most profitable trade, I took 28.75% gain, 8 days and a bit, in 21 hours. So nearly 9 days, 9 trading days, which also means minus a weekend, so it'll be like 11 days because it's spread out. 7 plus 2 for the weekend, 9 plus 2, that's 11 actual days. But most of them are clustered around this area, so up to a day, essentially. And so these are outliers, and most of them are concentrated around here. So these are winning trades. So 0 up to 18%, they're all within a day. 6 hours, 8 hours, and the losing trades as well. Which means I'm getting better at kind of getting my trades to function as an intraday setup. The risk of ruin is also getting much better. So if I looked at all my stats from last year to now, this will look much worse. But from February, I sort of started to be more consistent, cutting losses, putting stop losses, and managing that. As you can see, to lose 100% of the account, I need 48 consecutive trades. To lose 10% of the accounts, I need 5 consecutive losing trades, which some people might say it's too much on 5 trades, but it used to be much higher. So that's improved. So I just wanted to give you a breakdown of my stats to show you that I've improved quite a bit, and this is essentially where I'm at with my trading. And this week is going to be very important for me not to do anything to compromise the stats for this month, because next week is where a lot of action will be with some of the companies that I've mentioned, and also the fair rate decision. So just to kind of sum it up, the concentration of event risk is quite high. We have this wedge to break out of. Potentially this could be a downward break because of the general trend. We're not quite done with this bear trend. And also you could sort of trace levels here and say that we've come to a level that is, you know, roughly around here, where there was support in January, but of 2021, sorry, not 2022. So it's a kind of an old level, but it doesn't mean to say that it will kind of stop this going any lower. We have been lower in June, so we haven't got back to those lows. There's still quite a way to go there to 3686, so under 3700. We're currently at 3837, so you know, there's a fair bit to go even to get back to these lows in June. And then after that we'll see whether we'll continue lower or not. But as you can see, that there's quite a steep descent being honored at the moment, and there's no telling when this will be a bottom, market bottom. We don't know, so keep an eye out on things. The 4 hour obviously is due for a potential bounce of the simple moving average or the weighted moving average, which we're sort of seeing, or it might go lower, in which case there's quite a bit to travel until we get to these levels here, 3750, etc. And that's where we're at. So thank you very much for all your likes and all your comments and watching my videos. It's an amazing experience for me to share my trading and my thoughts, so thank you very much. And share, like, comment, subscribe, and I'll see you in my next video on Friday this week. Take care and happy trading out there.